Hi traders, and welcome to this video on trading reversals using the envelopes indicator. So the first thing I'm going to do is to place the envelopes indicator onto the chart here. This is a 1 hour chart of the euro dollar. I like to trade the 1 hour chart timeframes and above just because I find the signals tend to be more reliable regardless of the indicator you're using or price action, the support and resistance levels. It helps to filter out some of the noise that you can get from the lower chart timeframes. It also means less time chart watching. However, on instances, I will go down to the lower chart timeframes to pinpoint entry and exit points. So the envelopes indicator you can see here on the chart has an upper band and a lower band, or the upper envelope and lower envelope. And basically the main thing we're looking for is price to be on either side of the upper envelope or the lower envelope. So I've already done a video about trading breakouts, which you can find on my channel, trading breakouts with the envelopes indicator. Example here, breakout to the downside, here a breakout to the downside, here a breakout to the downside. So this indicator is really good for trading breakouts in line with the trend. However, it can also be useful in ranging markets. Basically, in ranging markets, we're not trading in the direction of the breakout, we're trading in the opposite direction. So a reversal trade, if you like. So if we just look for an example of a range, we have one here. So if we just mark resistance and support. So it's a short range, this one, but just to give you an idea of how you could use the envelopes indicator trading in a range, what you're looking for is price to fall below the lower envelope or go above the upper envelope. And when that happens, you want to take a trade in the opposite direction. Okay, you don't necessarily need to take the trade as soon as a candle closes below. For example, if you took the trade here in the opposite direction to the breakout for reversal trade, price would have gone against you 25 plus pips before turning around for a measly either get out for break even there or 15 pips here. However, had you waited for price to turn around where you could see this level of support was formed, you could have had a better timed entry. This bar here as well, this pin bar showing that the bears were losing steam. They obviously pushed the candle down here, pushed price down here, and then the bulls eventually pushed it back up. So this pin bar here would have been suggesting that the bulls are gaining some momentum back, and we may be looking for the reversal trade around here somewhere. Okay, so had we taken this reversal trade, price outside the lower envelopes, indecision in the market, we could have stayed in the trade until it crossed the upper envelope. You would have had around 20 pips there. Stop loss could have been relatively tight, 10 pips just below the low here. And it would have been a short term, well, a quick trade there. And then you could have done the opposite for a reversal when the price went outside the upper envelope here. Okay, you see it stayed out for a while, just like here, stayed out for a while, and then we wait for confirmation when price either comes back in here or the price action shows some indecision and price is turning, we obviously have this level of resistance that we've marked up here. Price didn't even make it to there before it started losing momentum in the upwards direction. This doji showing indecision. I have a bearish candle there, a pin bar again. This suggesting some bearish momentum. That coinciding with the breakout of the envelopes indicator in this range that we could have taken the reversal trade around here somewhere. Had we done that, I mean, we would have been in a good downwards trend there right at the start. So that's a good example of selling high. I mean, you wouldn't want to wait for the trend, you know. You'd be late to the party, perhaps, if you're trying to enter. Well, definitely if you're trying to sell around here. It's a good example of catching a trend and early opportunity. I mean, we did mention exiting on an opposite signal. Had you had done that, if you had sold here and exited there, you would have been disappointed, because you can see how far price continued down, which is why the initial stop loss probably would have been around this level of resistance and just on the other side. So 10 pips, which is tight, relatively tight stop loss on the 1 hour chart. You could have, when price did cross on the other side, moved the stop loss to either break even or the opposite side of the envelope. Yeah, and then trailed it all the way down. You would have been taken out here had you used the opposite side of the envelope, but then you would have had another entry opportunity, arguably on the reversal in the direction of the trend or the breakout. Alternatively, you could have just used levels of support come resistance for your stop loss. So had you waited, you could have gone to break even at this point, just to make sure you don't let your winning trade that you entered here turn into a loser had price had gone back up, let's say. And then in this instance, you can see that when price breached this support level, there was strong momentum in the downwards direction. And then you could have eventually used this level for your stop loss, and you would have locked in your trade for at least 25 pips profit. You could have either just moved it to a break to lock in the profit, or close some of the position. For example, close half the position here and just leave the remainder to run. Then when you've seen price form another level of resistance here and continue downwards, you might have moved your stop loss from there to lock in further profit and just continue to ride this downtrend without having to worry about a winning trade turning into a losing one. And this would have been a really, really good move to catch. I mean, there are plenty of instances when reversals will not always happen and price will continue, which is why it's important to have a sensible stop loss in place, but also use other forms of analysis for confirmation of your trades. That can be other technical indicators, it can be price action, definitely support and resistance, and things that lots of traders are going to be watching, especially big players, because they can have a big impact on how the market moves. Okay, so going back to this reversal trade, I think it's important to mention that a lot of people use the envelopes indicator for trading breakouts, and you can. There's nothing wrong with that. But in this instance, you would have been looking to trade a breakout probably around here somewhere, because you would have wanted the close bar, the confirmation, price action, maybe wait for this pullback here, or was the break of support. So yeah, say here you were, based on, let's just move this support. If you were using the, let me just clear the chart up a little bit. So you can use the envelopes to trade breakouts as well. So a breakout of the lower envelope there, breakout also of support. You can see there was a pullback that actually touched this support level, become resistance. You could have entered there, you could have entered on the initial breakout, and that would have been another opportunity to get into this downtrend. However, you would have been, around 25 pips late to the party had you been using a reversal instead. That being said, there are examples where if you were waiting for the breakout trade instead, you'd be saved from I don't know, fake reversal trades, let's say. But on the other hand, you also have fake outs, which is when, for example, here it looks like a potential breakout trade. Great, breakout of the upper envelope, let's get in, and then price came crashing back down. However, I probably would have waited to see price come to this resistance level in this breakout if we were trading breakouts instead of reversals on the envelopes, and you can see price didn't reach this resistance level, so that might not have been a breakout trade in any case. Or worst case scenario, it did go up 10 pips. You could have just quickly locked in some profit when you saw it turning around. But that's why on this example we had that strong level of support there, which confirmed this as a good breakout trade to take in comparison to this one. Okay, so as you can see, it's really easy to understand the envelopes indicator. It can be used in ranging and trending markets. I mean, look at this uptrend here. Ample opportunity to enter on the breakout of the upper envelope. I mean, you would have been starving if you were looking to enter on a reversal. You would have missed on a reversal on the lower band there. You would have missed lots of opportunity. However, as I said, reversals on envelopes tend to work better in ranging markets, whereas in trending markets such as this one, it's probably a good idea to look for breakouts and confirm with support and resistance, pullbacks, and like there, for example, nice resistance level and a strong breakout upwards. Can use the opposite envelope for your stop loss all the way up, trailing it, or the other side of the support and resistance. Can also be a stop loss level, which allows you to catch the majority of a move. Another thing worth mentioning is you can confirm your trades with other indicators. For example, the oscillator, stochastic oscillator. If you're not familiar with it, when price is above the 80 level, it's considered overbought, so we look to sell. When price is in or around the 20, below the 20 level, the market is considered oversold, so we're looking to buy. And when price, this line, the main line, crosses above the signal line, it suggests a bullish trend. When the main line crosses the signal line below, it's considered a bearish trend. This is a real basic indicator that you can find for free on probably all trading platforms. So for example, crossover there near the oversold zone coincides with a clear trend upwards there. have the level of support forming, resistance here comes support. Again, as we mentioned earlier, that's resistance as well, which had a good breakout there. You could have either entered on the breakout of that resistance level, even the pullback here. The stochastics confirming. So yeah, there's loads of different ways you can time your entry using a combination of indicators or one indicator. But if you're using one indicator, for sure you're going to want to use, well, I would always use price action, support and resistance. Stochastic crossover in the oversold zone again there. Let me just clear up this trend line. Stochastic oscillator oversold suggests market is heading up. Market does head up, and we could have, well, we would have seen, okay, support is holding there, good. Resistance there, let's wait for price to break through. It does here, and it goes above the upper envelope, suggesting a breakout. And again, another good trade on this particular trend for 80 plus pips. So there would have been ample opportunity to catch some good moves on this particular trend. Like I say, you can use the envelopes indicator on any chart time frame in various market conditions. You can use it in combination with other indicators, price action. Just make sure you have a sensible stop loss and use good risk to reward ratio when your winning trades outweigh your losing trades, because the last thing you want to do is to have a, I don't know, let's say a 50 pip stop loss, but only take 10 pips on your trades, because one bad trade can cancel out 5 winning trades in that example, not to mention the broker fees, spreads, commission, slippage, etc. Okay, well, hopefully you found something useful in this video. Thanks for watching. Please like and subscribe for more.